Hello, everyone. Jeff Dorman here, Chief Investment Officer at Arca, live again here on Monday from our new LA headquarters. Another edition of That's Our Two Satoshis Live, where for those who have never seen this before, we talk about events that are happening in the digital asset market. For those who want to read the full transcript, we write a blog at ar.ca at our resources page. Get the Arca blog, and you can see what we wrote about this week. But let's jump right into what is happening in the digital asset markets. So, a little bit of a divergence here. Bitcoin was basically flat week over week, Sunday to Sunday. But the rest of the digital asset market, for the most part, other than a couple of exceptions, really got hammered. Kind of a continuation of what we've been seeing most of this year, which is just kind of a slow bleed lower with relentless selling and or just a lack of buying. So a couple of reasons for that. Before we get into those things, a couple topics that we wrote about over in our blog that we're going to address here is what does it mean when you have the Fed increasing rates, you have war on the horizon, and what is that supposed to mean for digital assets? And then we'll also get into what we thought of the Super Bowl ads, specifically FTX and Coinbase's ads, and then talk a little bit about the Bitfinex Leo case study on event-driven investing and what it means with the DOJ recovering almost $4 billion of stolen Bitcoin, and what that means from a narrative standpoint. So let's dive in first to Bitcoin. Right, as I mentioned, Bitcoin held up much better than the other digital assets. For those who know me, I've been on record saying for a long time that intuitively this really just makes no sense to me. Right, there's nothing about Bitcoin that should act defensive. There's no cash flows, there's no yield, there's no intrinsic value. You could make a case that things like DeFi assets that actually have 10 to 20% dividend yields and have strong cash flows, or assets like gaming that have high cash flows and real sticky users, that should be more defensive than something like Bitcoin. But what I think doesn't really matter, right? The market is telling you that Bitcoin is defensive, right? We know a lot of funds in the space just move to Bitcoin anytime there's uncertainty. They treat Bitcoin like cash. But where is the uncertainty coming from? Let's start there, right? There's two things. One is the signaling of where interest rates are headed from the Federal Reserve. And two is the geopolitical risk coming from Russia and Ukraine. So the reality is we don't have a lot of context for what the digital asset market should do in these scenarios, right? Outside of Bitcoin and Ethereum, almost nothing that is relevant today in the digital asset world has been around more than 4 years ago, which means we haven't seen a real increase in rates and what it means for digital assets. And we certainly haven't seen a war. But we have seen what the effect for something like Bitcoin would be. So if you go back to January of 2020, if you recall back then, there was the Iran missile attack. And Bitcoin actually traded in line with gold and treasuries, right? Gold and treasuries being two of the most defensive risk-off assets on the planet. Bitcoin traded in line with those, right? Bitcoin was really treated almost in a geopolitical risk-off sense as a safe haven. So should you actually see more developments here coming out of Russia and Ukraine, it wouldn't be entirely surprising to see Bitcoin regain its past narrative, right? Right now, the narrative on Bitcoin is it's just a risk asset. It's just a 24/7 levered VIX. It trades with the NASDAQ. But the beauty of Bitcoin is that the narrative changes all the time. And if we see Bitcoin start to trade up in the face of imminent war and heightened geopolitical tensions, that could flip that narrative upside down again, which would be good for Bitcoin and also predominantly good for the rest of assets, which are largely in Bitcoin's shadow right now. Away from that, though, I don't know what these narratives will do for the non-Bitcoin digital assets, right? We like to think of things in terms of sectors, gaming, DeFi, CeFi, Web3, NFTs, et cetera. There's no real reason why rising rates would be damaging to the long-term narrative of these assets, in the same way that there's no real reason why increased geopolitical risk would be a negative for these. So you're up against factors that are difficult to trade. There's just no edge in a market like this. So if you're a long-only investor, you just say, I don't care what's going on right now, and you own it. And in some cases, that's what we're doing. If you're more of a shorter-term investor, go talk to some of the macro investors who have traded geopolitical tensions and rates for 30 or 40 years. It's really tough, right? There's just very little way to take advantage of markets like this. What I can say, though, in looking a little further out is, like most things, this will pass. What I towards, though, is a continuous differentiation of Bitcoin and the other digital assets. Fidelity Digital Assets recently wrote about this. They wrote talking about how Bitcoin is totally different. Delphi in their 2022, they had some really interesting talking about the differentiation of Bitcoin and other assets. And of course, on Arca, on our own blog, our own predictions, we've been saying, which is that these assets are just not similar whatsoever. Bitcoin is really going to be more of a macro asset, and these other assets are really going to be more based on cash flows and fundamentals and network growth. So we're excited to see that differentiation, even if it comes in a down market right now, because it does have long-lasting positive effects for the overall ecosystem. So we'll wait and see what happens this week with the closed-door Fed meeting that's happening today. The minutes of that come out on the 17th, which is Thursday, as well as obviously what ultimately happens here with Russia and Ukraine. All right, for those in the U.S., I'm sure you watched the Super Bowl last night. For those not in the U.S., you maybe did, maybe didn't. But there was a lot of hype around the digital asset ads. There were several of those to crypto.com, but I'm going to focus specifically on Coinbase and FTX. If you are a digital lover, you probably enjoyed the commercials. If you are a naysayer, you probably found a way to pile on. What I thought was most interesting was almost all the naysayers and negative attitudes about these commercials were saying it's just the dot-com era over again, and this is just a bunch of failed startups that are going to crash and burn like what happened in the 2000s with the early startups and the dot-coms. Or even my favorite, which was, why do digital assets need to advertise? Which is of course ridiculous to say, because the digital assets themselves weren't advertising. It was the companies that traffic in digital assets that were advertising. No different than when Charles Schwab or E-Trade or Fidelity advertises, right? It's not stocks that are advertising; it's the brokerages and the banks that are advertising. So I think what I really cared about, though, was that if you look at the two statements that Coinbase and FTX were making, I thought they were pretty powerful. So let's start with Coinbase. Coinbase, floating QR code, right? You stare at the screen and you just see the QR code bouncing up and down. Anybody who has ever used a phone probably immediately scanned the barcode. And in fact, there was 20 million people out of the 100 million people who watched the Super Bowl that scanned that barcode and ultimately crashed Coinbase's website for a few seconds. Coinbase became the number 2 app in the App Store today based on the volume that they received from that commercial. So what I thought was interesting from a messaging standpoint, though, is Coinbase was basically saying, we don't care about legacy traders and investors who aren't comfortable with technology. If you understand QR codes and you understand technology, you understand where we're headed with digital assets, and this commercial is for you. And I thought that was a really powerful message from one of the largest companies in this space. Second was FTX. FTX had the Larry David commercial, pretty funny, with all the points in history of technology taking over the world, where Larry David, basically said that none of them were going to work, and of course they did work. A lot of the polarizing opinions on this was, why would Larry David sell out for crypto? He already has so much money. Why would he do this? And it was a very Larry David response to the commercials. What I think people were missing is that this was FTX basically saying, any naysayer who is against digital assets is going to end up on the wrong side of history, right? This had nothing to do with trading. It had nothing to do with get rich quick. It had nothing to do with, what people think about when you think about speculation in digital assets. It was purely, this is a technology. It's happening with or without you. And if you continue to pretend that it's not going to work, even though there's been 10 plus years of history now of it working, you're going to be wrong. I think when we look back on both of these ads, we're going to look back on them pretty fondly, even though the mainstream media is having a field day trying to make false comparisons to the dot-com era. All right, and finally, and again, all this is available on our blog as well. I want to dive into Bitfinex and the Leo token for a minute. So for those familiar with Arca, we were an early investor in the Leo token back in 2019. For some context, Bitfinex in 2019 got in some trouble. They were not able to use banks very well, so they were using basically a offshore lender, and they had about $800 million taken from them from foreign governments. As a result, Bitfinex, the business, free cash flow positive, the business was fine, plenty of revenues, but they had a cash crunch, right? They just lost $800 million of their balance sheet. This is not unique to crypto companies. This has happened to traditional companies as well. In fact, there's a company called Knight Capital, which is a equity broker that had the same problem happen in 2011, where they had a fat finger error. One of their traders basically lost $500 million in a millisecond on a fat finger trade. And Knight Capital almost went out of business until they went out and raised money to shore up their balance sheet. The same thing happened to Bitfinex. They had to go out there and raise money, and they raised $1 billion through the form of the LEO token. Now, most digital asset investors back then in 2019 ran as far from this as they could, because this wasn't decentralization, this wasn't a protocol, this was just a company issuing a token. Here at Arca, we ran straight for it because we're like, this is going to be a great token. It's it's a good company that has pretty onerous terms on this token because they had no choice. They issued the token with a 33% cash flow sweep, which basically means any 33% of all of the top line revenues of Bitfinex would have to go back to towards this token and amortize it and buy it back. So pretty strong investor protections, pretty strong company. But there was a kicker, and that kicker was that if they ever recovered the stolen money, either from 2019, the 800 million, or from the 2016 hack, where Bitfinex had, I think, well over 100,000 Bitcoin stolen, that they were going to have to use that money to buy back the LEO tokens. So what happened over the last 6 to 9 months, we started to see movement in some of those old Bitfinex stolen wallets. And last week, there was an announcement from the DOJ that they actually captured 2 of the criminals who stole the money. And there's been speculation that Bitfinex will now, through a long, lengthy court process, will actually get this stolen Bitcoin back, which now, because of the rise in Bitcoin's price, is now worth almost $4 billion. So naturally, the LEO token jumped 100%, right? It went from $3 to over $6, actually hit $7 at one point, because if Bitfinex gets this money back, they're going to have to use that $4 billion to tender for a token that only had $2.5 billion outstanding at the time. So pretty big win for investors. So from an event-driven, catalyst-driven standpoint, home run for investors who like the LEO token, but also really interesting that this is a market that is more than just Bitcoin and layer 1 protocols, right? There really are some real companies from FTX and Binance and Bitfinex that have issued tokens in really creative ways. More importantly, other than just the event-driven investing, was the statement that the DOJ made, which was today's arrests and the department's largest financial seizure ever show that cryptocurrency is not a safe haven for criminals. Thanks to the meticulous work of law enforcement, the department once again showed how it can and will follow the money no matter what form it takes. I think this is the most powerful statement that we've ever seen from government. It's not the first time. The FBI said something similar a couple of years ago that most people dismissed, but it's really important, right? This is basically one of the biggest reasons why investors and larger institutions won't get into digital assets, is because they've heard this completely false narrative from the media that crypto is for criminals. The DOJ is now telling you, actually, not only is it not for criminals, it's the worst thing you can use if you're a criminal, because we can track it. So if you start going down the list of all the different reasons why people have stayed away from digital assets, they're just one by one going away. There's just no real legitimate reason anymore not to be in digital assets, right? Is it used for criminals? No, it's actually terrible. There's no intrinsic value, and digital assets can't be valued. Well, actually, just using the LEO case study a minute ago, you can see that they can be valued. There's real cash flows here. There's real revenues. There's real cash flow sweeps and tender offers. Maybe we don't have a Graham and Dodd methodology yet, but you can go on Token Terminal just to see all the different valuation techniques for cash flow producing tokens. Another reason people stayed out of the market is it's too volatile. Digital assets are volatile, but guess what? The 2-year Treasury just moved 25 basis points last week. That was a 3 sigma event. It was the largest move since 1979 in Treasuries. Right, the Nasdaq is down 13% and was down 15% at one point in the first 2 weeks in January. So if volatility is your reason to not be in digital assets, well, now as a debt or equity owner, you're starting to realize what real volatility looks like when the Fed isn't there to support you. So the point here is not to bash debt and equity. The point is, one by one, all of the reasons that people have stayed away from digital assets are disappearing. And that means that you have trillions, if not tens of trillions or even hundreds of trillions of dollars that have been sitting on the edge of the pool waiting for some reason to get in. They're going to start coming in. And that is supportive of risk assets like digital assets, even when we're in a down-only market like we seem to be right now. So long-term bullish, short-term, who knows? But definitely a lot of things going in favor of digital assets. And we're looking forward to seeing how all this plays out. So that's it for this week. Appreciate anyone who listened. Please check out our website, ar.ca. Check out the blog as well. And as always, you can follow me at jdorman81 on Twitter. Thanks, everyone.